So I think the number one thing is, as a trader or an investor, you don't want to let panic and fear take over, right? So just like you don't want to let greed take over when the markets just seem to go up forever, you don't want to buy at the top. You also don't want to let that panic come in. So, when I saw the drop on Friday and we know about the new variant that was coming out in COVID, you had to be aware that the markets tend to sell first and ask questions later. And sure enough, by Monday, we had the whole weekend to digest it. It definitely is a concern, but was it worth that big of a drop on Friday? The markets aren't telling us that at this point. So, I think the markets are telling us they're vulnerable to these black swan events. So we have to remain vigilant and aware that there is risk out there in the markets because things are so lofty in valuations. But at the same time, the buy the dippers came in again on Monday here, and we've seen a very, very big bounce.
Mm-hmm. I want to kind of get your thoughts on how these news pieces affect the markets here. Are there any other, external factors or announcements that you're watching for before the end of the year that are likely to cause more turbulence like this, ones that we can see coming?
Yeah. So like you said, the ones that we can see coming are the ones that the market can prepare for a little bit. So it's more a matter of, for instance, the Federal Reserve, if they decide to taper faster than anticipated, that might be something that the market's not prepared for. So I think that's what we want to watch for in December going into year end. I'm also curious about if there's any new developments in terms of new laws going into effect or tax hikes in 2022, where investors might say, hey, listen, I don't want to risk paying a higher, long-term capital gains tax. So let me sell into the year end. Everyone was calling for this end of year Santa Claus rally. And one thing I've learned in the history of my trading is that when everyone's saying something, you want to be a little cautious. And again, it just means that everyone's in that direction. So the markets inevitably want to go the opposite way just a little bit. So I think the Fed, number one, I think that, again, the markets are heavily levered. And that does make for these big drops like we've seen in the stock market, where you can see 2-3% down days in a split second.
So since the last time we spoke, we saw inflation numbers come in much hotter than expected. We saw the Fed announce their tapering plan. And I just want to get your thoughts on how you see the Fed affecting the general equities at this point. Have investors just really learned that no matter what, you buy the dip, even if, after you see even a 10% market drop?
Yeah, they have, right? Because if you look at the COVID collapse of 2020, we were down 20 to 30%. And I mean, how fast did we recover? So the market honestly doesn't believe that the Fed will ever continue to have a backbone. I mean, it's one thing to say, hey, we're going to taper by 10 billion a month or 15 billion a month. The markets don't think that the Fed will continue to be on that path for the long term. They think that as soon as the markets have a hiccup, for instance, what we saw with this new variant on Friday, we saw interest rates collapse, which told you that the market was anticipating the Fed stepping back because of this new variant. So again, you can only go for so long in a market without something occurring. And every time in the history of this market in the last 20 years, something has happened, the Fed has basically stepped back, reinflated things, printed more money. So the market has no basis to think that anything in the future would be any different. So it's really this lack of belief in the Fed having a backbone that is making people think, hey, I can buy on every dip, 2% dip, buy, 3% dip, buy, 10% dip, and just buy because it'll go right back up. And that, I have to say, is very concerning. Mm-hmm. That is something that as an investor, it starts to raise alarm bells because people aren't making decisions on valuations. They're not making fundamental or technical decisions. They're just saying, hey, it's going to go up. I can sell it to someone else higher. And that's the way they're feeling. And that is not a good way to invest.
So how does that play against their dual mandate? On one hand, we see them trying to talk about tapering, trying to get away from that. And yet, on the other hand, their behavior in the past has shown exactly the opposite, right?
Yeah, and that's the tricky thing with this dual mandate, right? And I've gone on record as saying it's one of the biggest fumbles in the history of the US is when Congress gave the Federal Reserve the dual mandate, because early on prior, it was all about, okay, you guys as a Federal Reserve monitor the money supply, make sure things are working properly, make sure that inflation doesn't get out of control. And then in 1977, they're like, hey, well, now you guys have to pay attention to unemployment and make sure unemployment stays low. And the problem with that is that, basically if the Fed has a backbone and steps on the market to kind of say, okay, well, we have to cut the inflation side of things and we have to be firm with the market, well, then what happens? The markets drop and unemployment rises. And now the Fed has to react and say, well, now we have to make the market go back up because we need unemployment to come back down. So it's this weird dichotomy where the Fed is just in this box about, well, which one? Do they have to be the strict parent on one hand and be firm so inflation doesn't get out of control? Or do they have to be the easy parent, the parent that spoils the child so that the unemployment rate stays low and everyone has jobs?
Mm-hmm. Yeah, it really just makes it seem like there's no, it's almost created the opposite of a free market now.
That's exactly what it has done. And I mean, I actually looked at the interest rates from the time. So if you go back to 1977, interest rates were basically at their highest point. And then since that dual mandate went into effect, you see like this stair step down. It's just like continues to go lower and lower on interest rates. And if we continue on this path, we will see negative interest rates at some point in the future. And you could understand why, because at some point another crisis comes. The Fed has to then come in and print more money and lower interest rates to re-stimulate and bring that unemployment rate back down. And eventually, where else are you going to go but negative interest rates? Now, eventually, the whole system collapses. That's kind of the worst case scenario, but that's the direction we're on at this point.
That was actually exactly where I wanted to go next, Gareth, was to interest rates. So you mentioned before that the Fed is basically stuck in a box here. Yeah. Do we ever actually see a meaningful hike in interest rates, or is it going to be a nominal hike in interest rates before we see the market panic and them step back from any of those actions, whether it's cutting more QE and actually trying to raise interest rates, or any of those actual reactions?
Yeah, I would say that you're never going to see a major increase in interest rates. I mean, again, I expect interest rates on the 10-year to maybe go to 2.25%, maybe 2.5%. But historically, that's nothing. So again, you have this much, you have so much U.S. debt at this point. You can't let interest rates go too high or the country will go bust anyways. And so you have to keep the interest rates low. Eventually, you have to devalue the dollar. So, I mean, it's this crazy bind about, okay, well, how much do you let inflation go up where it hurts the middle income and lower income groups in this country versus, well, how much money do you print and how much do you stimulate? And it is just this mess that they have created. And it's done to kind of please the short-term political scene. No Fed official, no Fed chair wants to be the chair that caused the massive collapse in the economy. So they kind of say, okay, well, let's do what's easy in the short term, just like our politicians, right? Every 4 years, there's another election. So they're not focused on getting this country on the right path for the next 20 years. They just want to do what makes people happy for the next couple of years so they get reelected. It's a very bad policy for the long term, but it's what human nature is right now.
And a lot of what you're doing is just basically analyzing raw data of human nature. So why don't we go to some charts, Gareth? Why don't we start with, let's say, the S&P or the NASDAQ? You and I were talking before we hit record here about this channel that we've seen the NASDAQ and the S&P both kind of trade within, right?
Yeah. And really amazing how charts work, folks. For those of you watching that, haven't really looked at charts, you have to just marvel at how a market like this can stay inside of this channel. And look at how this upper trend line, every time it hits this upper trend line, you see a drop, a pullback of sorts. You can see how the market on the S&P has gotten up to it. It's hovered right there. And every time it touches, like we just had a recent hit here, and then you had this pop making a new all-time high, which basically kissed that line that led us into Friday's decline. Now we're bouncing back. But as a trader, I really follow these because it gives you a good sense when the market's going to sell off. When do you pair longs? When do you potentially short the market? And then on the opposite side, if we sold off down to this trend line down here, you can see how here it hit and bounced. The same thing goes for the NASDAQ. Absolutely amazing. The difference with the NASDAQ here is that the tech sector is more volatile. So you've seen more hits of the low end of the trend line versus the S&P, but look at how it works amazingly well. Like here was the last hit, and it led to one of the biggest, shortest, fastest runs in the NASDAQ that we had seen. We went right back to that upper trend line. We then pulled back. We pierced it. We again pulled back. So the markets are being held inside of this range. And at least in the short term, as long as you stay within this channel, you will be okay in a market. It's still technically in an uptrend. What I would mention is that at any point, if you break below this lower trend line, that's where you would break trend. And that's where we could be at the start of a bear market. So if you're an investor out there, you could just say, okay, I'm going to stay long as long as we stay in here, even if we pull back, as long as you hover above this trend line or hit it, you have to assume a bounce. But if we break below, be really, really careful at that point. That would be where you would start to say, okay, I'm going to move to cash, or I'm going to be in gold all the way. Those type of investments would be wise at that point.
So that was my next question with that, Gareth, is, when we look at that, and you mentioned, short term, you're looking at that lower trend line. If we back out and take a longer term perspective, do you have any tools that can tell you, where we might see a reversal or what that reversal might be?
Yeah, I mean, that is like the trickiest thing in the world, right? Of where big one, it's easy to kind of predict when you have a trend line like this. Okay, you pull back off of it here, and then you do it here. Those are very short-term pullbacks. Honestly, I'll just tell you guys that, the last few times we've hit, I've said, okay, this should be the top, where it's a multi-month, multi-year top. And then the markets have proven me wrong in the short term. So, I think for us as traders, we have to kind of accept that this is the range. We've been in it for a long period of time. What we want to look for is when we break this lower trend line, then I think you can go out on a limb and say, okay, we might have a multi-month, multi-year high. We could be in the process of a 20, 30, 40, 50% correction in this market. And obviously at that point, it's more than a correction. But right now, again, the markets are just loving this channel. Perfect parallel lines, keeping the market in check. And by the way, this is partially algorithms trading, right? I'm sure algorithms are programmed to sell the high and buy the low on this channel. And also just human psychology. I think up at the upper line, you have max bullishness, which then dictates a reversal. And then same thing downside, people are finally starting to get scared, which enables the buyers, the short, you have some short covering down there and a reversal to take place.
So you mentioned, in a bigger crash scenario, you move all to gold. Or cash, whatever assets. What market or what conditions would make you move in that direction, Gareth?
So I think you definitely follow interest rates a little bit. I think interest rates have to be monitored. The market starts getting skittish anytime the interest rate on the 10-year starts getting close to that 1.75% high. I also think that you have to pay attention to geopolitical events. Any sort of Chinese movement towards Taiwan is definitely a concern. The Russian buildup on the Ukrainian border is a concern. I mean, those things may not turn out to be big events, but there are definitely potential for black swan events there. And then I think bottom line is you really want to follow the dollar. What is the dollar doing? Look for bigger moves in the dollar that could really put pressure on the system and potentially break it, if you will. So I think there are lots of things as a trader, as an investor, you want to follow. A lot of them have to do with the Fed and the interest rates, though. I would say that's the primary thing that I'm watching. With economic news coming out multiple times a week, you want to follow the interest rates. What are they doing? And then notice how when interest rates pop, dividend stocks tend to do better. So AT&T, really cheap PE, pays a nice dividend. Those type of plays you'd be interested in, while technology like Tesla, those tend to sell off when interest rates spike up.
So in that scenario, that's what we kind of need for gold and silver to start to have some momentum again, right?
Yeah, I think the biggest thing that you're watching, so with interest rates, it's really tricky, right? Because interest rates historically, at least over the last 20 years, when they go up, gold actually sells off. But we could argue that that's starting to break a little bit because inflation wasn't an issue for the last 20 years. So that inverse relationship held true. Now you're seeing inflation be the cause of interest rates going up. And that then creates more upside for gold in an interest rate environment where they're moving higher. So I do think you're on the precipice here of upside in gold. I've been, basically, I think every time I've been on with you, we've talked about how I am bullish on gold over the next 12, 18, 24 months, because I just keep on looking at the fact that the Fed may taper, but we know that it can't go on for that long until the next black swan event hits, and then they start printing again. And the inflation side, yes, you have a supply side issue, but there's also inflation based on a lot of other factors here, including the money printing, the debt, and everything like that. So you have to be just longer term bullish gold. And one thing I'm watching on the GLD chart, here's a GLD chart, right? This trend line right here is a chart, I think a trend line we talked about the last time I was on. We hadn't come up to it again for the third time, but look at how you hovered on that trend line and then it backed off again. So on a breakout position, you'd watch for this trend line to really break above or price to get above here. And then I think it goes back to $2,100 an ounce very, very quickly once you get above that. And eventually, I think by the end of 2022,